Hello guys, welcome back to my channel Commerce Insight. So today we are going to learn about ratio analysis chapter 10 from Introduction to Financial Market or IFM of grade 10 skill subject introduced by Cbse. So in this chapter we are going to learn about different tools that is being used to extract the information from the financial statement. So the most popular tool used here is ratio analysis. So it is being classified into four different groups. As you can see, the four groups are liquidity ratio, turnover ratio, leverage ratio and profitability ratio. So moving on to the first ratio, that is liquidity ratio. So liquidity ratio means it is the ability of the firm to meet the financial obligation in short term, which is less than 1 year. So liquidity ratio means it is the ability of the firm to convert the asset to cash within 1 year is known as liquidity ratio. So the term liquidity itself says to convert asset to cash. How quickly we can convert the asset to cash, that is liquidity. So liquidity ratio means the ability of the firm to meet the financial obligation within a year, or we can say short term, that is known as liquidity ratio. Now the first ratio coming under liquidity ratio is current ratio. Now current ratio means it measures the ability of the firm to meet its current liabilities from current asset. So it is same as the liquidity ratio. So current ratio means it measures the firm's liquidity, how quickly we can meet the current liabilities from current asset is known as current ratio. So again explaining, current ratio means it measures the ability of the firm to meet its current liabilities from current asset is known as current ratio. So the formula to find current ratio is current asset by current liability. So the formula to find current ratio is current asset by current liabilities. So the next ratio coming here is asset test ratio or quick ratio. So quick ratio or asset test ratio, it means that it measures the firm's ability to convert quick asset into cash. How quickly we can convert the asset or current asset to cash to meet the current liabilities or the liabilities of the firm is known as quick ratio. So quick ratio means how the firm converts the current asset, how quickly the firm can convert its current asset into cash to meet the current liabilities is known as quick ratio. So the formula to find asset test ratio is quick asset by current liabilities. So what is the formula to find asset test ratio? Yes, quick asset by current liabilities. Now the question may arise, how do we find quick asset? So to find quick asset, all you have to do is add all your current asset except inventories and prepaid expenses. So what is quick asset? Quick asset means it is all your current asset except inventories and prepaid expenses. I hope the first ratio is clear, liquidity ratio. So what is liquidity ratio again? Yes, liquidity ratio means it refers to the ability of the firm to meet the financial obligation within 1 year, and current ratio and asset test ratio means how the firm meet its current liabilities from current asset, and asset test ratio means how the firm convert the current asset quickly to cash to meet its liabilities. So these are the two important ratio from liquidity ratio. I hope that is clear. If you have any doubt, please do comment. I will be explaining in next video. Moving on to the next important ratio is turnover ratio. So turnover ratio means it measures how quickly a certain asset can be converted to cash. That is known as turnover ratio. So turnover ratio simply means what? How quickly we can convert the current asset into cash, or how efficiently the asset can be employed by the firm, in how efficiently we can use the asset to meet the current liabilities, that is known as turnover ratio. Now the first important ratio coming under inventory turnover ratio, coming under the turnover ratio is inventory turnover ratio. So what is inventory turnover ratio? Inventory turnover ratio tells how efficient how efficiently we are managing the inventory, means what is the efficiency of the inventory management. So it is found in times. So how many times we are using that inventory, so that is known as inventory turnover ratio. So inventory turnover ratio simply means it tells what is the how efficiently we are using the inventories, that is known as inventory turnover ratio. So the formula to find inventory turnover ratio is cost of goods sold by average inventory. So you may have the doubt, what is cost of goods sold. So to find cost of goods sold, the formula is given sales minus gross profit. Everything will be there in the balance sheet, trading account and your P&L account. So all you have to do is take that particular item and subtract it. So how do we find cost of goods sold again? Yes, sales minus gross profit. Now average inventory. So average inventory, how do we find average inventory? It is the simple average of opening stock and closing stock. Again, you may have the opening stock and closing stock, whether it will be given in the question. Yes, it will be always given in the question. So it is already there in the question itself. It will be there in your P&L account, or it will be there in your trading account. I will be discussing the question by the end of this video. So average inventory means it is a simple average, or we can say opening stock plus closing stock whole divided by 2. So that is known as average inventory. So what is inventory turnover ratio again? Inventory turnover ratio tells the efficiency of the inventory management. So according to this ratio, higher the ratio means the more efficient of inventory management. So if the ratio is higher, that means the inventory turnover ratio or inventory management is more efficient. So that is known as inventory turnover ratio. Moving on to the next ratio is debtors turnover ratio. So what is the formula to find debtors turnover ratio? Net credit sales by average debtors, or other name for debtors is accounts receivable. So you may be confused, what is accounts receivable? Something we have to get. So money, debtors means money we have to get. For example, I'm giving money to one of you guys and you have to pay it back to me. So that is known as debtors. So money which the firm have to get. So something we have to get this asset. So that is why debtors. That is the meaning of debtors. So debtors means, I hope you understood what is the meaning of debtors. Debtors means it is the firm. The firm may have given money to the other firms or any other persons. So it's something we have to get it back, that is known as debtors. So debtors turnover ratio means net credit sales divided by average debtors or accounts receivable is known as debtors turnover ratio. Now what is the meaning of debtors turnover ratio? So it shows how many times accounts receivables turnover during a year, means how many times how many times the debtors are paying over a period of time. That is known as debtors turnover ratio. I hope that is clear. So higher the debtors turnover, the greater the efficiency of credit management. So credit management means what? Yes, credit management means we are giving our products on credit. So if the ratio is higher means the credit management is good. So debtors turnover means what? It shows how many times the accounts receivable turn over during a year is known as debtors turnover ratio. Now what is the formula to find debtors turnover ratio? Net credit sales divided by average debtors or accounts receivable. These are the two names for debtors. Now next formula is average collection period. So what is average collection period? It represents how many number of days worth credit sale is logged in debtors. What is the total number of days that is being given to the debtors or logged in with the debtors, that is known as average collection period. So the first formula for average collection period is average debtors by average daily credit sales. So that is known as the first formula, I'm really sorry. The first formula to find average collection period is average debtors by average daily credit. Now the second formula is 365 days divided by debtors turnover ratio. Now a first point is, once you're finding debtors turnover ratio, you can use the second formula very easily. Now if you're not able to find the debtors turnover ratio, then you need to use that average debtors divided by daily credit sales, average daily credit sales. This is how we find average collection period. So what is again average collection period? Yes, it represents the number of days worth credit sales that is logged with the debtors. So that is known as average collection period. Now moving on to the next very important ratio is fixed asset turnover ratio. Fixed asset turnover ratio means it measures the sales per rupee of investment in fixed asset, or we can say in other words, how efficiently the fixed assets are employed. That is known as fixed asset ratio. So fixed asset ratio means what? It measures sales per rupee of investment in fixed asset, or we can say how efficiently we are using fixed asset. That is known as fixed asset turnover ratio, and the formula to find fixed asset turnover ratio is net sales by net fixed asset. So net sales by net fixed asset. Now in this particular ratio, you can see what is the ratio's name, fixed asset turnover ratio, and you can see in the formula net fixed asset is seen in the denominator. So when a question comes, you can simply write, the question is asking what is, write the formula for fixed asset turnover ratio. So simply fixed asset is already given here, so this will be your denominator. Now to find the turnover is always in sales, so sales, net sales by net fixed asset. That is the formula to find fixed asset turnover ratio. Again, turnover is always found in sales. Fixed asset is the turnover, the ratio's name. So this particular item, fixed asset, will be a denominator. Turnover is always in sales, so that will be a numerator. So sales by fixed asset, or net sales by net fixed asset. This is your formula. Now next formula is total fixed asset turnover ratio. Same, net sales by average total asset. So what is total asset? Total asset means current asset plus current asset plus, yes, current asset plus fixed asset is your total asset. So total asset means it is the total of fixed asset and your current asset. That is known as your total asset. So how do we find average? It is a simple average of both. I hope that is clear. If you're having any doubt, please do comment. I will be making another video on your doubts. Now moving on to the next very important ratio, that is leverage ratio. So leverage ratio means it shows the soundness of the firm. It measures the soundness of the firm in terms of ability to pay the interest regularly, or it shows the ability to repay the principal amount on due dates. That is known as leverage ratio. So the first important ratio is debt equity ratio. So debt equity ratio reflects or shows the contribution of creditors and owners to finance the business. It shows what? It shows the contribution of creditors and owners to finance the business. That is known as debt equity. Debt and equities. So contribution of the creditors and the owners together into the business is known as debt equity. Same by debt equity, debt by equity. So total debt by equity is known as debt equity ratio. It's debt, D-E-T, B is silent, okay? It's debt equity ratio. Moving on to next ratio is debt asset ratio. So debt asset ratio means it combines what? Long-term debt plus current liabilities. So that is known as debt asset ratio. Simply the ratio itself is a formula. So debt asset ratio is debt by total asset. Debt by total asset is debt asset ratio. Next one is interest coverage ratio. So interest coverage ratio means earnings before interest and tax divided by interest. So what is interest coverage ratio? Earnings before interest and tax divided by interest. Yes, it shows what? It shows the interest coverage ratio of the firms. So it shows the firm's ability to pay the interest, that is known as interest coverage ratio. How do you find interest coverage ratio? Yes, earnings before interest and tax divided by interest. Now moving on to the next formula is debt service coverage ratio. So DSCR, debt coverage, it shows what? It shows the debt service capacity of the firm, means how much the company can pay back, or what is the capacity of the firm to take a debt. That is known as debt service coverage ratio. In financial institution, they use average of DSCR for a period during which the term loan of a particular project is payable. Means, for example, if you are taking a loan, so the company or the financial institution will be calculating how long we can pay it back. So that is known as debt service coverage ratio. So how do we calculate DSCR? So profit after tax plus depreciation plus non-cash expenditures along with interest on long term divided by interest on long term plus repayment of long term. So this particular formula, just keep it in your mind. That may not ask in your question paper, but these three ratios are the most important ratios that may come for your exam. So moving on to the last topic of today's video, that is profitability ratio. So what is profitability ratio? Profitability and operating or management efficiency of a firm is judged mainly by profitability ratio. So it shows how the firm is judged with the operating and management efficiency. So we can find what is the gross profit, we can find what is the net profit. It shows how much profit the firm is earning. That is known as profitability ratio. So the first important ratio is gross profit ratio. As you can see, I have put percentage over here. So percentage, this particular ratio is always found in percentage. So you have to multiply it with 100. Keep that in mind. Okay, so gross profit ratio means what? Gross profit ratio, simply gross profit. So gross profit will be your numerator. So gross profit by, so profit is always found in what? It is always found in sales. So gross profit by net sales into 100%. So it is always in 100. You have to multiply with 100. So what is gross profit ratio? Yes, gross profit by net sales into 100. So gross profit, that is your numerator. So how do we find gross profit? You find it with the help of sales. You get your profit from your sales. So gross profit by net sales into 100. Next one is net profit ratio. Here same percentage. How do we find net profit ratio? Good. Net profit by net sales into 100. Net profit by net sales into 100 is your net profit ratio. Same as gross profit ratio. Net profit also we find it from the sales. Yes, that is known as net profit ratio. Moving on to next topic is return on total asset. So return on total asset, the formula is profit before interest and tax divided by total asset. Return means profit. So profit before interest and tax divided by, on what we have to find? Total asset. So total asset is your denominator. Now what is your total asset? We have already discussed. Current asset plus fixed asset is your total asset. I hope that is clear. Moving on to next formula, that is return on capital employed. So return on capital employed, the formula is net profit after tax divided by capital employed. Capital employed means total of fixed asset, current asset minus current liabilities. Simply we can say shareholders fund. Okay, capital employed means the amount of shares purchased by the shareholders. So the total capital invested into the firm is the total capital employed. Sometimes in the question you may not have capital, so in order to find the total capital employed, you can use total as you have to add all your asset side and subtract your current liabilities. You will be getting your capital employed. So what is return on capital employed? Net profit after tax divided by capital employed. Now next topic or next formula is return on shareholders equity. So return on shareholders equity, the formula is net profit after tax divided by average total shareholders equity, or we can say net worth. What is the total net worth of shareholders? So net worth of shareholders includes what? Net worth of shareholders include what? Equity plus reserves and surplus. So return on equity shareholders or shareholders equity, the formula is net profit after tax divided by net worth. Net worth means equity plus reserves and surplus. Don't worry, everything will be there in the question. All you have to take the particular item and add it. Okay. Now the last formula and very important formula of this particular topic is earnings per share. So earning per share, it measures the profit available to the shareholders, per share, that is known as per share they hold, that is known as earnings per share. So earnings per share means it is the profit available to the equity shareholders that they hold. Every shares they hold, what is the profit available for each and every shares, that is known as earnings per share. Now the formulas for earnings per share is net profit available to the equity shareholders divided by number of shares they hold. So what is EPS? EPS is net profit available to the shareholders divided by number of shares outstanding. So that is known as EPS. Now the last ratio is earnings per ratio, or we can say PE ratio. So PE ratio is market price per share divided by EPS. So market price per share means what is the market value of the present share divided by EPS. EPS we have already found just before. So first you have to find EPS, then you have to find PE ratio. I hope that is clear. If you're having any doubt, please do comment. We'll be discussing the format of balance sheet and we'll be discussing one question in the next video. Till then, bye. Have a really good day. Please do like and subscribe my channel. Bye.